Thank you so much for the response. I appreciate it. Thanks.
You're welcome.
Well, so I think that I'm jumping around a little bit only because I think some of these questions have already been answered. So Ben asked in the chat, is there a play which we can use to hedge against inflation? So I think Matt just touched on that. He says, I follow an investor who's buying puts on a 20-year bond fund. You can do stuff like that too. Just be careful. Matt, you got any thoughts on that about any kind of exotic financial strategies? So I've heard one, which is a ratio call spread on gold, or like a ratio put spread, back spread on the bonds, things like that, where you would basically sell like at the money and then buy out of them, like buy 2 times out of the money later on, and all kinds of crazy stuff like that.
Yeah, I think there's gonna be a lot of advanced strategies you could put to work like that, and some of them may or may not pay out. You'll have to sort of think about your own probabilities. The challenge with hedges, I guess what I would say is, rather than owning, I'd rather own a business that's producing something than just gold that's sitting there. And so if you really need to, and you want, just go to like a profitable gold miner or something, at least do maybe something like that, where at least you have a business around it. The problem with hedging is that hedging tends to be a tax, and we don't know exactly what the outcome is going to be, even if the hedge is correct. So I do think, with a small fraction of your capital, you can think back to the Kelly criterion we discussed, Jonathan, you can put on some of those exotic hedges, and they may pay off, but over time, I think if you do it consistently over time, you're probably going to find yourself at a net even or even a loss. So, and these all expire. The challenge is that what you've described expires. And so you have to put it on and then put it on again and put it on again. But people like Ackman have done well with some hedges. There's different opportunities. They're pretty advanced, some of them. We actually had a similar hedge on the portfolio I described in an annual letter, I think in 2020. And we were doing something similar to what you just described. We were basically buying a put on the S&P 500, and then we were selling 2 out of the money puts, far out of the money puts on the S&P 500, because we recognized the S&P might fall due to certain factors, and if it did, at some point we'd be happy to cover it, and then if it fell far enough, we'd actually be net buyers because we're value folks. So we did this multi-decade analysis of how far drawdowns can go, and we realized if there's a 40% drawdown, we're happy to buy. And I describe it in detail, and the challenge was, and it actually was profitable, but the challenge was that there's expiration dates, and if everything doesn't expire perfectly, now you have to start making transactions and trades around your previous hedge. And it becomes quite complex. So on paper, it looks really great. And then when you're in the moment, so inflation spikes, and it turns out that we have, say 15% inflation, and then prices fall and prices move around. Now, when do you unwind your hedge? So you fall into that issue as well. And so hedging is a little bit complicated. You could do it with a small portion of your capital, but I really would, I would suggest to most folks out there to just do bottom-up analysis and find great opportunities and buy and hold those great opportunities. And if you can't find one, you can just buy or even sell a put on Berkshire Hathaway, and you can let Warren Buffett find the opportunities for you. Because Warren Buffett isn't out there putting on hedges due to inflation. He's just making investment allocations and buying great businesses, and that's where I think most people should look.